You ever wonder what actually happens to your money after you deposit it? I mean, how does the cash in your savings account or your pension fund somehow help build a brand new skyscraper or get a tech startup off the ground? Well, in this explainer, we're going to follow that journey. We'll trace the path of your money from your pocket all the way into the global market.
Okay, so here's what we've got on tap. We're going to trace the flow of money from savers, people like us, to the big companies that need it. We'll unpack the golden rule they use to make smart investment decisions, and then we'll get real about the link between risk and reward, because you can't have one without the other. After that, we'll see how companies try to strike the perfect funding balance, and finally, we'll look at the all-important human side of things.
All right, first up, let's connect the dots. We're going to start with that fundamental link between your personal savings and the massive projects that literally shape the world around us. So really think about it. How does your pension end up funding a new factory? I mean, they seem like they're in completely different universes, right? But they are so deeply connected. The financial system is like this invisible engine, humming in the background, gathering up the savings of millions of people and channeling that capital straight to companies for their biggest, boldest projects. This diagram just lays it out perfectly. The best way to think about it is like the economy's plumbing. Over on the left, you've got households. That's you and me, the savers. Our money flows through all these intermediaries, think banks and asset managers. They're the pipes, and it gets directed to corporations over on the right. They use that money to build, to innovate, and to generate the profits that flow right back into the system, which is what fuels all of our economic growth. Okay, so we get the plumbing. We know how money gets from point A to point B. But think about it. With a bajillion projects and new ideas floating around, how on earth do companies decide which ones are actually worth funding?
Well, the answer is this really powerful tool called net present value, or NPV. You can think of it as a financial time machine. It takes all the money a project is supposed to make in the future and tells you what all of that is worth in today's money. And this is so critical because a dollar in your pocket today is always, always worth more than the promise of a dollar tomorrow. And the rule for using it? It's just beautifully simple. If the net present value is positive, meaning the project is going to generate more value than it costs, you go for it. If it's negative, you walk away. That's it. It is the absolute foundation for making smart financial decisions.
And here we see NPV in action. Look at year zero. That's our initial cost, $1,000. The next columns show the cash we expect to get back in the future, and more importantly, their discounted value, what they're worth today. So when you add it all up, you get a positive NPV of $235. That's the green light. That tells you this project is going to create value. But here's the thing. NPV is based on expected future cash flows. And let's be honest, the future is never a sure thing. And that brings us to the other side of the investment coin, risk. This chart is just mind-blowing. It shows that if you had put just $100 into a portfolio of small stocks back in 1925, it would have mushroomed into over $15 million by 2010. Now, compare that to super safe treasury bills, where that same $100 grew to just over $2,600. It just shows you the incredible power of higher risk investments over the long, long haul. But, and this is a big but, that growth is not a smooth ride up. This chart shows the volatility. See how the returns for the safe treasury bills are all packed together nice and tight? Now look at stocks. The returns are all over the place. We're talking huge gains one year, big losses the next. That spread, that wild unpredictability, that's what we call risk.
So this is the crucial point, this fundamental trade-off. These two charts capture it perfectly. Over on the left, you can see small stocks gave you the highest average annual return, no contest. But then look to the right. They also had the highest standard deviation, which is just the fancy finance term for volatility or risk. The takeaway? There is no free lunch in finance. If you want to shoot for higher returns, you absolutely have to be willing to stomach greater risk.
And this whole risk-reward thing isn't just for investors. It's a central puzzle for companies themselves when they're figuring out how to raise the money they need to fund all their big ideas. So, a company basically has two main ways to get cash. It can sell ownership stakes, that's equity, or it can go out and borrow money, that's debt. It's kind of like buying a house, right? You can use your own money, that's your equity, or you can get a mortgage, that's your debt. And the critical multi-million-dollar decision for any company is finding the perfect mix of these two. We call that its capital structure. Okay, let's start in a simple, perfect world. Just for a second. As a company takes on more debt, things get riskier for the owners. Why? Well, because if the company gets into trouble, the lenders always get paid back first. The owners are last in line. So, to make up for that extra risk, shareholders demand a higher potential return. This makes equity more expensive, and it perfectly cancels out the benefit of the cheaper debt, so the company's overall cost of money just stays flat. But of course, we live in the real world, and in the real world, debt has a huge advantage: taxes. The interest payments a company makes on its loans, they're tax deductible. This creates this valuable tax shield that actually lowers the company's overall cost of capital. So what's the catch? Well, if you borrow too much, the risk of going bankrupt, what we call financial distress, starts to climb. And that starts to scare investors and drive your costs right back up again. And this whole balancing act is what the trade-off theory is all about. It says there's a sweet spot, an optimal debt ratio. It's that magic point where a company perfectly balances the awesome tax benefits of borrowing against the rising costs of maybe getting into financial trouble. Finding that sweet spot is the key to maximizing the value of the entire company. So far, we've been talking a lot about these elegant theories and numbers, which are all nice and clean. But finance is also messy, and it's messy because it involves people with all their own motivations and incentives. This brings us to a really core concept in finance: the agency problem. See, in most big companies, the owners, the shareholders, aren't the same people running the company day to day. That's the managers. And this separation can create a serious conflict of interest. Are the managers, the agents, really acting in the best interests of the owners, the principals? Or are they looking out for number one? And this isn't just a theory. This stuff happens all the time. Managers might spend company money on perks, like fancy private jets. They might chase short-term profits to pump up their own bonuses, even if it hurts the company in the long run. Or even worse, if the company's in trouble, they might just decide to bet the whole farm on a super risky project. If it pays off, hey, they're a hero. If it fails, well, it's the shareholders who lose all their money. That's something called moral hazard. So after this quick journey through the big principles of finance, what are the key takeaways? What are the tools you can now use to think more clearly about this stuff? We've basically built a foundational 3-part toolkit. First, you've got the NPV rule. It helps you make decisions by always asking, does this create more value than it costs? Second, the risk-return principle. It forces you to be realistic, reminding you that there's no reward without risk. And third, the agency problem. It helps you understand the all-important human factor, that incentives drive everything. And this quote really just ties it all together. At its very core, that is what finance does. It is the vital, dynamic process of taking money that's just sitting there and putting it to work to create something of real value. So the next time you see a headline about a company launching a new product or taking on a ton of debt or changing its CEO, you'll have the tools to understand the why behind it all. You're now equipped to see the deeper story playing out. Thanks for joining this explainer.